Hello traders, welcome back to the most awaited second season of the comprehensive course on smart money concepts. First of all, I would like to sincerely apologize to all my subscribers for delaying this season of SMC course. Please understand that it was not intentional as it took me a long time to do the research and write scripts for these episodes in an orderly manner that will make sense. I always prefer quality over quantity, and I guarantee that you will love this season and it will change the way you trade forever. I have planned out the entire course into 5 seasons. In the third season, we will learn different smart money strategies. In the fourth season, we will focus on some of the Forex only SMC concepts and strategies. And in the final season, we will discuss the rest of the smart money concepts. There won't be much delay between these new seasons because I have finished writing all the episodes. So don't worry about that. In this second season, however, we will learn different smart money concepts and a few strategies which can provide high reward to risk trading setups. I will try to explain each concept as detailed as possible in the most simplest manner as I can. I hope you are as excited as I am. Anyways, understanding these smart money strategies will require a decent idea of all the important smart money concepts that we have learned in the first season of this course. So I strongly suggest that you go back and watch the entire smart money concepts playlist, which is available for free in the channel, where I have made detailed explanations of each of the concepts. Only after that should you start watching this season of the course. On the other hand, if you are someone who have already completed watching the first season and all you need is a brush up of some of the main concepts, then this video will serve your purpose. This video will help you recollect some of the most important smart money concepts. But let me tell you, this will not just be a simple recap of the concepts. Instead, I will discuss some of those ideas which I have missed out on the first season. So even if you have completed watching the first season recently, you should still watch this video. With that being said, in this video, I'll be talking about the market structure, the fractal nature of market structure, pullbacks, strong and weak highs and lows. I will talk about inducements, fair value gaps, different POIs or prices of interest, premium and discount zones, and so on. So once again, welcome back to your favorite trading education channel. Just before we get into the serious part, show some love for the efforts and dedication put into bringing quality content as always. Your likes and comments matters the most in the growth of this channel. And if you're new here, I request you to subscribe to the channel for trading knowledge that will actually help you become profitable. Now, without wasting any more time, let's dive in. The biggest mistake I see traders make is that they don't understand what side of the market they should be trading on. Should you go long or should you go short? So the first and foremost lesson you need to understand is the identification of the smart money. In other words, it is about understanding the actual intended direction of the price. This is a very simple concept to understand. So essentially, the idea based upon SMC is that at all points in time, prices in the market are making higher highs and higher lows, or lower highs or lower lows. It is either bullish or bearish. If the price is bullish, we will be looking only for buys or long trades. On the opposite, if the price is bearish, we will only be looking for sells or short trades. It's really that simple. Now, how do we identify whether the price is bullish or bearish? This is where market structure comes into picture. Essentially, market structure is what's going to indicate to us what direction the price is trading. This is how a textbook market structure will look like. This is usually the type of market structure that you have probably been taught in the price action videos. Obviously, it works, but when we get into the realistic market structure, you will understand it's not as simple as this. But anyway, let us take a look at the textbook market structure first. So if you look at any price move like this, you will see that price forms these swings or waves on it. And essentially, you just want to map out all of these swing points and you'll notice whether or not they are trending upwards or downwards. So we will start off with a low, then we have a high, then we have a higher high. This new low formed is higher than the previous low. Therefore, it is a higher low. This already in itself is indicative of higher prices, right? So we have prices moving higher. So we have a low, we have a high, we have a higher low, and then a higher high. So when the new high closes above the previous high, it forms a break of structure or BOS. More specifically, it forms a bullish break of structure. In this case, the market is trending higher or the market is bullish. Therefore, we are anticipating the prices to trade higher, which in turn means that we are expected to buy or take long positions. Now, once again, the market creates a valid pullback and then moves up. At this point, we can again expect higher prices. So, another break of structure will support this analysis and the market will form a new higher high. This won't keep going forever. At some point, like in every market, the trend will shift. At some point, you will be trading a bullish market trend like this. And then eventually, you will have what we call a change of character. The change of character is essentially the shift from a bullish to bearish trend, or it could be the other way around also, where a bearish trend turns bullish. So, the change of character is the first phase of a market reversal. So, when you get a change of character like this, then you can see that we have now gone from having higher highs and higher lows. Instead, now what we have is a lower low. From there, it's likely that we get a valid pullback and then prices form a lower high compared to the previous high, meaning that this new high formed right here is lower than the previous high formed. This is a clear indication of upcoming lower prices. Once again, when the market forms a new low which is lower than the previous low, then you have a break of structure. More accurately, this is a bearish break of structure. This forms a new lower low. So once you have a change of character followed by a break of structure, that is absolute confirmation that the trend has shifted, and in this case, it is now bearish. In a bearish market, we wait for price to pull back up into these levels and then we expect the price to trade lower. And our job as a trader is to identify how we get involved in these levels. In this case, we are expected to sell or take short positions. Now, yet again, if the price falls below the previous low and it breaks and closes above the previous lower high, forming a new higher high, then this is another change of character towards bullishness. If the price pulls back, forming a higher low compared to the previous low, and forms a bullish break of structure, forming a higher high, then our bullish bias strengthens and we can now focus on trading long positions only. So when price is trending lower, go short, and when market is trending higher, go long. It is that simple. And this cycle will continue. Now, these swing points formed in the market structure are identified as the external swing points or major swing points. These are the points that make up the external or major structure. So, what you can see here is a high followed by a low, then forms a lower high which closes below the previous high, and the price continues to decline, making a lower low, forming a bearish break of structure. This confirms a bearish market trend. So, our objective is to go short from any area of value like an order block, fair value gap, etc. after the market forms a valid pullback. Once again, the market forms a lower high followed by a lower low and a break of structure. But here, the price trend shifted. Instead of forming a lower high and reversing after a pullback, the market breaks and closes above the previous high, forming a higher high and a change of character towards bullish. Our bullish bias is strongly confirmed when the price pulls back, forming a higher low compared to the previous low, and then breaking above the previous high to form another higher high and a bullish break of structure. So, our objective is to take long positions from any prices of interest like order blocks or fair value gaps. This is how we expect prices to behave in the future as represented by the dotted lines. First, it should pull back to any area of value like an order block or fair value gap from where we can enter into long trade positions, and then we can expect the prices to progress higher to achieve our target. Now, you see, this is a extremely basic version of the market price delivery. In reality, the market price delivery is quite complex and advanced. Now, this is how a real market structure will look like. You need to understand that this is more like what you see in the markets. But trust me, it is actually easier than it looks. Let's quickly break it down. Essentially, we are going to do the exact same thing. We are going to start from the high point up here to the low down here. So we have a swing high and we have a swing low. Now that is our baseline. Anything that happens within this is purely internal. Once you have identified the external or major swing high and low, then what you can do is draw a box or rectangle from this swing low up to the swing high. This way, you can understand that any price moves that are now taking place inside of this box is the internal or the minor structure. So when you see that price is creating higher price swings like this, a lot of traders will make the mistake of trying to go long from these minor swings because they think that this was a break of structure and it is time that they should go long. But the truth is, the structure still remains bearish. It is very clear that our high remains intact. And so, what do you think will happen to these traders? Most probably, the price will continue to trade lower and it will form a break of structure towards the downside, and all these traders would get stopped out. And once there is a structure break, we can now look for our lower low. But before that, we need to identify where our swing high is. Our old swing high was up here. Our new swing high will be the highest point formed before the price pull back before breaking the structure. So the highest point is formed right here after the pullback before the bearish structure break happened. Now this becomes our new swing high. So we can expect the market to continue lower and respect this new swing high. Now once again, we are expecting that price will come up and then trade lower from any prices of interest. Once it does that, that is when price forms a valid pullback after a break of structure. We can then mark the new lower low. And again, price moves lower, forming another break of structure. And then again, what do you observe? You can notice price pulls back up and then price trades lower. Another bearish break of structure is formed. And so what we can do is that we can capitalize on all of these price moves after the pullback, which is in line with the current bearish trend. We can take short trades from any price of interest. I will show you exactly how to take trades from the upcoming episode onwards. So this here is a bearish price action or a bearish market structure. But at some point, inevitably, even though you're expecting prices to go lower, the market trend will shift and price will start moving higher. Now, as traders, our duty is to adapt to such changes. So here the price has shifted from bearish to bullish as the market breaks above the previous lower high. So the price has just created a change of character. This will result in a higher high being formed. In such cases, we want to trade long positions from prices of interest. Our job is to catch the reversal from these areas of value. Because you can notice that every time price shift, it forms these little reversals. We want to trade these reversals in alignment with the trend. That is the whole idea. So again, we know that price is going to now create a higher low after a pullback. In that case, we can confirm our new higher high, and then again, price moves higher and creates a bullish break of structure. Now we are officially bullish. That's confirmed, right? Now, what else can you do? What you can do is essentially you can draw a box or a rectangle from this swing low up until this swing high, and you can just drag this box across. And the idea is that you can wait for the price to break out of this box. This method will help you distinguish between the internal and external market structures. So when price breaks out of the box, it obviously confirms a valid break of structure. But as you can see here, there is price action happening inside this box. This is where most traders get trapped. Most of these traders lose money because they always get caught on the wrong side of the market. See, our external structure is bullish, but then we start to see prices pushing down lower like this. This is nothing but the minor structure. For some reason, many traders think that price is bearish because it's generating lower lows, when in reality, this is just a pullback which happens after every break of structure. Unaware traders think that this pullback is an actual structure and they get confused. And most likely, when they see another minor structure break, they will try to short in these minor levels here. And then what happens? They just get stopped out most of the time because they are on the wrong side of the market. I hope you understand. So it is very important to talk about these pullbacks. In fact, it is crucial to tell apart a real pullback from a fake one. A simple yet effective tool that can come in handy is the Fibonacci retracement tool. It can serve two purposes. It's like hitting two birds with a stone. It can be used to distinguish a valid pullback from a false pullback. Also, it can be used to determine the premium and discount areas within a major swing move that could help us buy low and sell high, improving our reward potential. Let's start with identifying deep pullbacks. Let's do it for a bullish scenario. Take a look at these higher low and higher swing high points. This is an external swing move. Now select the Fibonacci tool from the sidebar. You can start drawing from the swing low and drag towards the swing high point. The Fibonacci levels get plotted automatically. So a deeper pullback is a retracement that moves to 38.2% to 50% or even lower Fibonacci levels without closing below the swing low. So if it closes below the swing low level, then it is no longer a valid pullback. Instead, it is a change of character. This is very important to comprehend. So any pullback pushing below the 38.2% Fibonacci level can be considered as a deep pullback. And a lot of the time, we see price retracing back to this golden region, which is between 61.8 and 78.6% Fibonacci levels. This is usually a very strong sign. Now, only when the price moves higher after a valid pullback can we actually confirm a higher high. Likewise, we can confirm a higher low only after a valid break of structure, where the price has to break and close above the previous higher high level. Now, let's do it for a bearish scenario. For this, take a look at the lower high and lower swing low points. These are the major swing points of the external structure. Now, select the Fibonacci tool from the left sidebar. You can begin plotting the swing high and then drag it towards the swing low. For a deep pullback to happen, price has to retrace to the 38.2% to 50% or even higher Fibonacci levels. So any pullback going over the 38.2% Fibonacci level can be considered as a deep pullback. But make sure that the retracement move doesn't break and close above the previous swing high. In such a case, it is no longer just a pullback, instead it is a change of character. Now, once the price forms a valid pullback and reverses lower, we can actually confirm a lower low. In a similar note, a lower high is confirmed only when the market forms a bearish break of structure where the price breaks and closes below the lower swing low point. Now, there is another way of identifying a valid pullback. It is with the use of inducements. We will talk about this soon. But before that, let's look at the second use case of the Fibonacci retracement tool. It is plotting the premium and discount areas or zones. We will start with a bullish swing structure. The idea is the same. Identify the swing low and the swing high levels in the uptrend market structure. Select the Fibonacci tool from the menu. Start by plotting from the swing low and drag and proceed towards the swing high level. For this purpose, we will only require 3 fib levels. These are the 0%, 50% and 100% levels. You can go to the Fibonacci settings and adjust accordingly. So the region between 0% and 50% Fibonacci levels are considered as the premium zone, while the area between 50% and 100% Fib levels are considered as the discount zone. Since the external structure is bullish, our bias would be to take long trade positions. We all know the basic rule in trading. It is simply to buy at lower levels and sell at higher levels. With that in mind, we should try to take our long trade entries from the discount zones because we get cheaper prices there. On the other hand, prices are expensive within the premium zones. That's the whole idea. Now let's quickly run through the case of a bearish swing structure. So here, as always, identify the swing high and the swing low. Select the Fibonacci tool from the menu. Start marking from the swing high point and proceed lower towards the swing low point. Our Fibonacci levels will be marked. Contrary to the previous case, here the region between 0% and 50% Fibonacci levels is considered as the discount zone, while the area between 50% and 100% Fibonacci levels are considered as the premium zone. Since we are bearish, our bias will be to sell or short at higher prices. Therefore, we should try to take our short trade entry from the premium zones because we get higher prices there. I hope you have understood the overall idea. Now, let's briefly talk about liquidity. In simple terms, liquidity is the fuel for price moves. Markets always move from one region of liquidity to another area of liquidity. Liquidity is just an area where there are stop losses and pending orders waiting to be executed. We can find liquidity in areas or zones where many people place their stop losses and limit orders, which can either be buy or sell orders. So, a market with a very high liquidity is one where there are a large number of buyers and sellers willing to trade in that particular asset. This means that there is a high availability of buy and sell orders, allowing transactions to be executed quickly and with minimal impact on prices. There are two main types of liquidity based on market structure. These are major or external liquidity and minor or internal liquidity. In simple terms, major liquidity is the liquidity associated with the external swing structure. This includes the liquidity available near the major swing highs and lows, major support or resistance levels, daily, weekly, or monthly highs and lows, etc. Minor liquidity, on the other hand, is the liquidity available near internal market structures. This could be in the form of equal highs and equal lows, trendline liquidity, flag patterns, etc. Now, liquidity can also be classified based on direction. They are buy-side liquidity and sell-side liquidity. Buy-side liquidity represents a level on the chart where short sellers will have their stops and breakout buyers will have their limit orders positioned. So essentially, these are buy stop loss orders set by short sellers who sold from the resistance or the swing highs, and also buy limit orders set by buyers looking for a breakout above the resistance. So these are essentially buy orders. Now, sell side liquidity is just the opposite. It represents a level on the chart where long bias traders will place their stop loss. So essentially, this cluster of orders will include stop loss orders set by buyers who went long from the support level or swing low, which in turn is a sell order, and it will also include sell limit orders set by those sellers who are anticipating a breakdown below the support or swing low. So in essence, the smart money will try to manipulate the prices in order to break through these obvious liquidity zones and seize or absorb the liquidity available there. This is called liquidity grab or liquidity sweep. Usually, this is done in 3 steps. An accumulation phase where a large number of orders get clustered around a particular level, followed by a manipulation phase where the smart money traps the retail players into taking a trade in the wrong direction. This is where the liquidity sweep happens. And finally, the price reverses direction, taking out all the trapped retailers. This is the distribution phase. You can watch the detailed video on liquidity and how it works in the third and fourth episodes of the first season of our course. Anyways, now let's talk about inducements. The idea of inducements rely on minor pullbacks. It acts as a check to prevent traders from entering a trade position too early and helping them wait for a valid pullback to happen. The concept of inducement is very simple. An inducement is considered as the first pullback after a valid break of structure has happened. These pullbacks are minor pullbacks or internal pullbacks, which can be formed using a single candle, a group of candles, or even a deep wick. You can see different types of pullbacks that you can find on the charts here. So the whole idea is to mark the first pullback formed after a valid break of structure as our inducement level. This definition stays true despite the market trend being bullish or bearish. Now, in certain scenarios, we might need to tweak this rule a little bit. Take a look at these bullish market scenarios. In the first case, we can see the price break and close above the previous major swing high. This is our valid bullish break of structure. Now, let us see what happened after the break of structure. You can notice how the price moved higher and then it formed a minor pullback. As per our definition, the low of this minor pullback is our inducement level. We can draw a small horizontal line at this low to mark the inducement. For easy identification of this line in the future, we can name this line as IDM, or you can also use a dollar sign for the same purpose. Then the price moved lower and broke below this inducement line. Only when the inducement level is taken out should we start thinking about a trade. Mostly, the market will move in the direction of the existing market trend after taking out the inducement. Keep in mind that this does not have to happen immediately. Price can reverse after sweeping a liquidity area, or it can reverse from an order block also. But do keep in mind that a price reversal after an inducement cannot be predicted with 100% accuracy. There are instances where the market could just break through the major swing level and form a change of character instead. Now let's consider this second case. In this scenario, we can observe that the price moved higher and it tried to break above the previous swing high level. But price didn't manage to close above the previous higher high. So this is not a valid bullish break of structure. So we cannot spot the inducement just yet as per the first pullback definition. Soon, the price did manage to break and close above the previous major swing high level, thereby forming a valid break of structure. After that, price moved higher and formed a minor pullback. We can now mark the low of this pullback using a line, and this will be our inducement level denoted by IDM or a dollar sign. And afterwards, you can see that the price returned back to take out the liquidity below this inducement line. Now, only after the inducement line is taken out, should you think about taking trades from an order block or from an area of liquidity. Now, take a look at this third case. In this case, it is clear that the price formed a valid break of structure. But as per our definition of inducement, the price didn't create any minor pullbacks after the bullish break of structure. The price moved higher with momentum. But if you look closely, you'll observe that the price did form a pullback just before the break of structure. So in such instances where there is no pullback formed after the break of structure, we will consider the last minor pullback before the break of structure as the inducement level, and we can mark it using a line and name it. Now, if you notice what happened next, you will see that the price returned all the way down and it took out the liquidity below the inducement level, and then only it moved higher. So this is a special case where you have to make certain adjustments and just not blindly follow the textbook definition of inducements. Now take a good look at this last scenario. Here the price gave a clean breakout above the previous higher high level. So it is a valid bullish break of structure. Then the price moved higher and formed a minor pullback. So as per the rule, we will mark it as our inducement level. Now, instead of returning back to take out the liquidity, the market moved higher and then it formed another minor pullback. Now, what will we do? If such a scenario takes place, we should shift one inducement level forward to the low of this newly formed pullback. Even if the price doesn't take out this inducement level, and if it moves even higher and creates another minor pullback, then without any doubt, we should shift our inducement line to this new swing low formed. This is yet another important tweak that you have to make in the concept in connection with the basic rule of the first pullback. Now, as you can see, the price returned to sweep the liquidity below the inducement level, and then the market continued higher after absorbing the liquidity. Now, the idea remains the same for bearish instances also. You can watch my detailed video on inducements to understand the finer details. Now, in reality, inducement levels are considered as smart money traps. This is because it induces retail traders to enter into short trades from an inducement level, which is usually above any high probability price of interest or demand zones during a bullish market structure, thereby inducing them to trade in the wrong location as well as in the wrong direction. In a similar manner, they persuade retail traders to enter into a long trade position from an inducement level, which is usually below any price of interest or supply zones during a bearish market structure, making them trade in the wrong location as well as in the wrong direction. It is just a trap to use them as liquidity. This is why it is always recommended to take trades once the liquidity associated with inducement level is taken out. Because once the price has swept the liquidity associated with an inducement level, there are good chances that the price can reverse. Now, moving on, let me briefly talk about the concept of strong and weak swing points in a structure. To identify strong and weak highs and lows, we obviously need to identify our structure correctly. Are we bullish or are we bearish? In this case, we are bullish. Now, keep in mind this idea that the job of a high is to take out a low. Likewise, the job of a low is to take out the high. It is as simple as that. So, if a low succeeds in taking out a high, that low becomes a strong low. In a bullish trending market structure, the market forms consecutive higher highs and higher lows. Here, the lows always manage to take out the highs. Therefore, the higher lows act as strong lows. Most of the time, these lows are protected, and as a result, when price gets to these lows, it will be met with some resistance, causing the market to move higher. On the contrary, these higher swing highs fail to take out the previous swing low levels. Therefore, these levels are weak highs. Most of the time, it is not going to hold, and eventually, price breaks through these highs. The only time it holds is when there is a market structure shift. That is, if the high manages to take out the low, thereby creating a bearish change of character. In this scenario, the previous low gets taken out and it represents a shift in control from buyers to the sellers. So now this high will become a strong high. Now there can't be two strong levels at the same time. Now this high is strong, therefore this low is already considered weak. It's like that saying, innocent until proven guilty. This low is weak until it is proven strong. This low right here would have to break this high to regain its status of being a strong swing level. Only when this high is taken out will the buyer be back in control over the market. But assume that didn't happen and the market moved lower, forming a bearish market structure. In this case, the lower swing lows were not able to take out the highs, suggesting these are weak lows. On the contrary, the lower highs did their job by breaking through the lows, suggesting that these highs are strong highs and there is a very high probability that they will hold. Or in other words, price could face a strong resistance from these highs and the market could return lower. Understanding this concept will help us trade according to the market sentiment. It tells us when to switch between trends. So the entire idea of strong and weak swing points revolve around the concept of liquidity and shift between the control of power between buyers and sellers. Now, let's quickly look at the concept of fair value gaps. In simple terms, a fair value gap is a three candle formation where the first candle's low does not overlap with the third candle's high in case of down move, or where the first candle's high does not overlap with the third candle's low in case of an up move, with a condition that the middle candle has to be a large bodied candle with little or no wicks. A fair value gap represents an area where there was no efficient price delivery. It represents an imbalance in the buy and sell transactions, leading to an inefficient price action in the market. So, the idea is that the prices will return back to fill this imbalance or inefficiency in the market. This is what most traders would look for. Now, a fair value gap that has not yet been tested by prices are called unmitigated fair value gap, and those that are tested by prices are called as mitigated fair value gaps. Even though identifying a fair value gap based on the three candle rule looks very easy, yet there are some exceptions to this rule which we need to consider. For instance, the internal consolidations or inside candle formations need to be considered while marking the three candle pattern making up a fair value gap. You can learn a lot more about fair value gaps, displacements, consequent encroachments, etc. on my detailed video on fair value gaps in the first season of this course. Moving on, let me now talk about order flow and order blocks. Let's begin with bullish order flows. During a bullish market, the major price structure forms higher highs and higher lows. But if you observe the corrective moves, you'll notice that it forms lower highs and lower lows. So, a bullish order flow is represented by the last selling price move before the bullish price momentum, or in simpler terms, the last selling move before the buy is called a bullish order flow. Therefore, all you have to do is to identify the bearish candles before the price begins to move higher. This is how we spot bullish order flows in the chart. Let us now learn how to spot a bearish order flow. You will find bearish order flow in a bearish market structure. In a bear market, the major structure forms lower highs and lower lows, while the corrective move forms higher highs and higher lows. And the bearish order flow is represented by the last buying price move before the ongoing bearish price momentum. Or in other words, the last buying momentum before drop or sell is called bearish order flow. Therefore, you need to identify the last bullish candles before the price began to drop lower. Now, order flows can be classified into three types. These are mitigated order flows, unmitigated order flows, and failed order flows. Out of these three, only the unmitigated order flows are of any use to us. An unmitigated order flow is one which has not been tapped into by prices. Or in other words, the price hasn't already mitigated the order flow yet. I have also presented scenarios for mitigated and failed order flows also. Even though order flows can be used as potential trade entry zones, there are a few major drawbacks while doing so. First of all, the stop loss will be considerably large. Since order flow is a zone or an area in the chart, we will have to place our stop loss beyond the area or zone. Even then, we cannot be sure if the price would return back to hit our stop loss. And because of a large stop loss, the reward to risk also reduces. The reward to risk provided by an order flow trading opportunity is much lower as compared to that given by an order block trading opportunity. Another problem with order flow is that there is no proper entry criteria. Entering a trade position from an order flow zone is mostly about our intuitions and reward to risk considerations. Yet another problem, which is committed due to human error, is the wrong identification and marking of order flows. If you make the mistake of marking the order flow wrongly, then most probably the price won't return to mitigate it, or sometimes it will fail the order flow. This is where order blocks come in. Order blocks are considered as a refinement of order flow. Let's look at what the textbook definition of order blocks are. In a bullish market scenario, a bullish order block is identified as the last bearish candle before the buy. And during a bearish market structure, A bearish order block is considered as the last bullish candle before the sell. This is a vague way of explaining what an order block is, and it is of very little use to a trader. The majority of order blocks obtained using this method are useless and it won't probably work. To identify and mark only valid and high probability order blocks, you will have to take into account 7 important factors. Let me quickly run through these factors. The first point is that you should mark order blocks on higher time frames only. So if you are an intraday player, then 15 minutes can be your higher time frame and you should mark order blocks on this time frame only. Moving to the lower time frames such as 1 minute charts in order to refine your trade entry is a whole different game which we will cover in the upcoming episodes. Anyways, identification and marking of order flows has to be done on the higher time frame charts. The second factor is that there should be a valid break of structure. If you are in a bullish trend, look for a bullish break of structure. In this case, only look for a bullish order block. Instead, if the market structure is bearish, only look for bearish order blocks. Now, third thing is to look for the last buying candle before the sell for a bearish market structure and look for the last selling candle before the buy for a bullish market structure as per definition. But certain conditions apply to this step. You need to make sure that this candle has taken out or swept the previous candle's liquidity. In simple words, you need to check if there is a liquidity sweep involved. This means the last selling candle that we have spotted should take out the previous minor low formed. This also means that the next candle should not take out the low of the last selling candle. If the last selling candle was unable to take out the previous liquidity, or if the succeeding candle takes out the low of our last selling candle, then we will not consider this candle for marking our bullish order block. The same concept applies to the last buying candle before the sell also, while marking a bearish order block. Now, the fourth important factor to notice is that there should be an imbalance or fair value gap involved. This imbalance should be formed after our last selling candle in case of a bullish market structure, and it should be formed after our last buying candle in case of a bearish market structure. Another important thing to look out for is that there should be a proper inducement after the break of structure. This step is to avoid traders from falling into the smart money trap. And the final factor to check for is to see whether the order block is associated with an unmitigated order flow. This will help you filter out most of the low probability setups. Usually, after filtering, you'll be most likely left with a minimum of 1 order block and a maximum of 2 order blocks between a particular swing high and a swing low. These are number 1, the extreme order block, and the second one is the decisional POI or the decisional order block. The extreme order block is considered the high probability order block because it is the last resort for the price to make a reversal, as there is enough liquidity and imbalance available. On the other hand, trading from a decisional order block is a 50-50 bet. The overall idea when it comes to trading order blocks is to wait for the price to pull back to this price of interest and then wait for a reversal from this order block. This is where you can take a trade entry in the direction of the existing trend. But there are other nitty-gritties that needs to be considered. I will talk about order block trading strategies in the upcoming seasons. Anyways, order blocks provides you with limited trades which are of high quality and have a high probability of success. Secondly, the reward to risk ratio is largely improved when using order blocks. This means the stop loss setting is much tighter. The trade entries are also more optimized due to limited number of trades on offer. On the downside, a tight stop loss can be taken out by volatile price swings. Now, this was just a quick recap of what an order flow and order block is. But if you want to get a deeper understanding on these topics, I suggest you watch the comprehensive video on this topic in the first season. Now, let's talk about another interesting aspect of the market, which is the fractal market structure. It is one of those key concepts that helps you find high reward to risk trades. This concept lets you refine your trade entries using a multi-time frame approach. It is known as lower time frame refinement or LTF refinement. You might already know this. So it's nothing new. But anyways, let's break this down. What you see here is a 15-minute time frame chart. Now I will bring up a series of zigzag candlesticks layered over the 15-minute chart. These candlesticks represents the 1-minute time frame. What you have to understand is that every time you have a very clean move like this on the higher time frame, a noisy price run like this is taking place on the lower time frame. For example, let's say in the 15 minutes, the market printed 5 candles like this. Then in the 1-minute time frame, it's going to print a lot more candles, precisely 75 of them, and these are going to be a lot more erratic. So, the first step to follow is to identify our bias based on the major structure direction. If the major structure is bullish, our trade bias will be to trade long positions, and if the higher time frame bias is bearish, our whole objective would be to trade short positions. Okay, now take a look at this 15-minute time frame structure. The market formed a low, then a high, followed by a higher low, and then a higher high with a bullish breakout structure. At this point, we are bullish. Then, price break below the previous low, forming a lower low, suggesting a change of character. So now we are bearish. That is what the 15-minute swing structure tells me. So keep in mind that as of now, the 15-minute structure is bearish, and these are our 4 major swing points. Okay, now let's bring in the 1-minute time frame structure. You can see the 1-minute chart printing consecutive higher lows and higher highs during the initial impulsive move in the 15-minute time frame. It formed minor bullish breakout structures. Then, in the higher time frame, the price made a pullback. This is how the market moves. It moves as waves with impulse and corrective moves within it. But if you look at the 1-minute chart structure during this pullback phase, you will notice that the lower time frame structure is printing lower highs and lower lows. And as you can see, the price formed an internal change of character. This change of character or market structure shift in the lower time frame structure will give you a heads up about the pullback in the 15-minute structure. So if you were already in a long position, this minor change of character will help you exit from the trade. Now again, the 1-minute lower time frame structure formed minor bearish breakout structures. Then as you can see, the 15-minute higher time frame structure reversed higher, forming an external bullish breakout structure. But if you notice carefully, you'll find that the 1-minute structure has already given clues of a reversal. The lower time frame structure made a minor bullish change of character here. So this is a great sign for traders to enter into long trade positions. So the idea is to mark the higher time frame price of interest in the 15-minute chart, then go down to the lower time frame 1-minute chart, and then plot the lower time frame prices of interest areas to refine your analysis with a confluent setup, that is, to look for overlapping areas in the prices of interest. Now, once there is a change of character in the internal structure, you can take trade entries in the trend direction from these confluence areas inside the price of interest. So a lower time frame fractal analysis will not only give you a heads up about the expected trend, but it will also help you refine your trade entries, thereby improving your reward potential and reducing your potential losses. With that idea in mind, let's quickly run through the rest of the chart and wind up this video. Look what happened next in the 15 minutes time frame. There was a change of character towards bearishness. The price broke and closed below the previous swing low to form a lower low. Now focus on what has happened on the 1-minute structure. Just like the previous case, there is an internal change of character towards bearishness, thereby printing lower highs and lower swing lows. It continued lower, forming minor bearish breakout structures. Eventually, instead of the price making a pullback and reversing back from any price of interest, the price actually broke through the previous major swing level. After that, the market once again moved higher, forming a pullback on the higher time frame structure. This pullback is identified much earlier on the lower time frame structure when it formed an internal bullish change of character. Now, if you have followed me through this video, you can easily predict what is going to happen next. It's simple. There is a good chance that the higher time frame swing high is going to be protected and that the price is going to reverse after it mitigates any price of interest. This reversal can be predicted when the price forms an internal bearish change of character in the 1-minute structure. You can look for short trade entries and trade in the direction of the higher time frame structure direction. Your target could be the next bearish break of structure level. I hope this concept is clear. So, this was a quick recap on the most important smart money concepts. I know there are other concepts that we have already discussed, but trust me, these are the most vital concepts that you as a trader needs to master if you are going to use SMC for trading. You can always go back to the first season of the SMC course to refresh your memory. In the upcoming episodes, we will talk about different smart money concepts that we have not yet discussed and a lot more. I hope this video was informative. If it was, kindly consider giving a thumbs up so that I know you guys are interested in such content, and I'll try to make more such videos. Hit that like button and show some love for the time and effort being put into making useful, orderly, and practical content. Also, share this video with your friends and fellow traders. And if you have any doubts or queries, feel free to drop in a comment. And if you are new to this channel or you have not yet subscribed, please make sure to subscribe and also enable the bell icon to receive notifications about the latest video uploads. I will see you guys in the next video. Till then, bye.